Michael Gapen with us, folks. Barclays Capital, working with Dean Mackey and Larry Cantor. And there comes a time and place where you got to mark things down or sometimes mark things up. People get behind an economics expansion. What was it like with your team today as you looked at this jobs report and you finally, not capitulated, but you just had to simply adjust down from relative optimism to a very tepid view for this quarter and next quarter?
That's right. And the debate that we were having is it's clear that the data was coming in slow and Q2 would be weaker. But what we were looking for is on the back of the ISM manufacturing report the other day and the jobs report today is how much of this would carry into Q3. So we were looking at much slower Q2. The question was how much further would it carry? And what we decided to do today was bring down both Q2 and Q3. So the fact that higher headline inflation cut into consumer spending, that's a well-known story. But both the ISM and employment report today suggest businesses have pulled back more sharply than we thought, and we think that also will bring down Q3.
It's almost stock versus flow 101, but on a level basis, does the delay in economic growth that Cantor, Mackey, Gapen was looking for, do you just delay that down the road into late 11 or 12, or did it evaporate into an earthquake in Tokyo? Did it evaporate into higher oil prices?
So we're still constructive on the recovery in the sense that we think consumer spending and business spending will continue to push the recovery forward. So for us, it was about defining what temporary is. And the supply chain disruptions that you mentioned, the surge in headline inflation that you mentioned, the weakening confidence suggests that this will be a longer slowdown than we had initially anticipated.
Victor, wander over here. I know you're busy over there on the far side of the set. Folks, this is the reality of market economics. You have pages of analysis. And here's a quiet note from Barclays this morning, from Dean Mackey, with this markdown. Just two simple paragraphs. And I got to go in there in real time on radio and find the key sentence. To me, it was a lack of inflation. There's good news here in this slowdown, and that pain of inflation may disappear.
That's right. So the one bright spot in this report was in hours worked and average hourly earnings. And our view is that headline inflation will begin to roll over in the coming months. We think it'll be roughly flat in May and may even decline in June. That should help consumer spending rebound going into the third quarter.
We showed you Paul Krugman earlier. On the opposite side of the fence, Team Chicago, it's like Bruins Canucks. Here we are, John Cochran, University of Chicago. Is QE2 a savior, inflator, or a dud? It's dangerous for the Fed to claim immense power and for us to trust that power when it's helpless. If Bernanke admitted to Congress there's nothing the Fed can do, he might have had a much better effect. I can't pronounce that word. When you look at this, Michael, is the Fed impotent?
We wouldn't say that the Fed is impotent, but certainly we would say that QE2 has had a much stronger financial market effect than it has a real side effect. Part of that has to do with the state of banks and the lending channel and the channels through which QE can work. We think it mainly works through the net wealth channel and propping up equity prices and potentially home prices, and it works through the trade channel. But trade in the U.S. is a much smaller percentage of the overall economy. It's difficult to push the dollar down. So, yes, it had more of a financial market effect.
I look at all this, and I want to go back to, the financial markets and aid for New York and Washington versus the quote-unquote real economy. And we don't mean John Deere and Peoria doing well. What does savers do, given this focus on supporting a banking system, supporting an elite?
Well, we think ultimately savers will be rewarded by taking on additional risk. So that would mean increasing allocations to equities, remaining in high yield, fixed income space. It is a situation right now where the Fed and policymakers are keeping real yields low in order to generate a recovery. That recovery is slow in coming and very choppy. Ultimately, we think investors will be rewarded, though, for taking more risk.
Let's bring up this chart again, folks. As Michael mentions, real yields, long-term view. This is just the 10-year. This is not a chart the pros would use. They'd look short-term, 10-year yield, less inflation. I can't remember what I used, CPI or Cleveland CPI. That's how rare this accommodative policy is, isn't it?
That's right. It's extremely rare. So when you look at Treasury yields all the way out to 10 years, the real return is negative or flat. For a long-term investor, that ultimately means your risk reward is much better served in another asset class.
Okay. That was a short answer. It's Friday. You're allowed to have longer answers, so I don't have to talk. Earlier this morning on Bloomberg Surveillance, I spoke with Bill Gross of PIMCO, and I asked him what savers should do in this economy.
Savers should run to the extent that they can risk a little bit of their capital. Then there are alternatives in real interest rate space. You have to take a little bit of a chance in order to avoid getting your pocket picked here.
Would you like to make any equity recommendations today, as Mr. Gross did on radio? Would you like
no.
Procter & Gamble, like he meant? People want to fire here. Bill Gross recommending stocks. Do you want to get yourself in trouble with the economic department?
No, I don't think I'll do that, and I'll keep my recommendation to the broad asset class itself.
When we look at C plus I plus G plus net exports, can net exports come to the rescue?
Yes, but not to the point where it carries the entire recovery. So a weaker dollar, it's down about 10% or so since QE2 started, will help boost trade. But as you mentioned in a previous section, manufacturing jobs have been gutted in the U.S. for a long time. Rebuilding a manufacturing and export base is a long-term strategy, not necessarily a way to get out of the current recession within a 1 or 2 month period, 1 or 2 year period.
I'm thrilled you came over today, particularly after not a capitulation, but just a markdown in your view. Really appreciate you coming on today.